Hello and welcome to this episode of Macro Sutra. I'm TCA Sharad Raghavan, Deputy Editor at ThePrint, and now the big news of the day for international economics and finance is of course the 50 basis point rate cut by the US Federal Reserve. How is this going to impact India? Is it going to help us, hurt us, or not affect us at all? To discuss all of that, we have with us Radhika Pandey, Associate Professor at NIPFP. Thank you so much, Radhika, for joining us.
Thank you, Sharad.
So now, Radhika, there was an expectation that the US Fed would cut rates.
Right.
But was 50 basis points a surprise?
Yes, so there was a debate on the quantum of rate cut because there were two views on this issue. There were one section of analysts who were of the view that the rate cut should not be too massive and it should be 25 basis points because the Federal Reserve should be data dependent and then take a more calibrated, measured view of the situation because if there is a steeper rate cut and if then Fed might have to reverse its policy if inflationary pressures are rekindled again. So that was one view, but the other view was that because labor market has been cooling in US and inflation has come down from the highs of almost 9% in 2022 to 2.5% now as per the recent data. So it is time to cut interest rate and cut interest rate by 50 basis points. So particularly the markets were expecting a 50 basis points rate cut and if we look at the trajectory of the market returns both globally as well as Indian market, they were all expecting a massive at least a 50 basis points rate cut, and therefore that is why we were seeing that markets have generated positive returns. They have been scaling new highs over the last couple of days. So markets were expecting a 50 basis point. Analysts, some commentators, economists were of the view that it would be better if the Fed goes for a 25 basis points rate cut.
And then maybe 25 later. If
25 later, and if inflation continues to fall, then maybe go in for another 25 basis rate cut and then another, because there are still two meetings left for this year. So there is scope. So that was the view, but the Fed went for a 50 basis points rate cut. And if we see the commentary, they are mostly they are saying that they don't want to fall behind the curve. So that's the main concern that they had raised, the main reason that they have given, because if we look at the rate tightening cycle that the Fed initiated in 2022, at that time because of the supply bottlenecks and the Russia-Ukraine war, inflation was rising, but the Fed started raising rates from March 2022. Inflationary pressures were building before that. So that time again they were criticized that Fed is falling behind the curve. This time they didn't want to take that risk. So it's particularly risk management and also to help the borrowers who have been facing high borrowing costs. So all in all, yes, we have a 50 basis points rate cut.
So overall then, over the last 2 years, what exactly has reversed in the US economy that they are now comfortable doing such a large rate hike, to do with the labor market as well as inflation?
Yeah, so they did a rate hike and now this is a rate cut. So
a rate cut, sorry.
Yeah, so in 2022 was the time when they started raising rates, and that was, as I said, mainly because of two reasons. Firstly, supply side bottlenecks, and secondly, during that time as COVID pandemic impact was abating, the demand resurged. And US was one country where they got a lot of fiscal stimulus, so there was a resurgence in consumer demand. So that led to increase in prices. Supply could not match with the increased demand, so it resulted in higher prices. And by June 2022, inflation had touched 9%. So that led them to start increasing rates, and that is one of the longest spell of rate hike, where from March 2022 till July 23. The US Fed increased rate 11 times.
And during this time also the labor market was showing relative strength. So they were comfortable raising their hikes.
Yes. So at that time the main concern was to cool inflation because labor market was strong. There were no conditions of recession or slowdown in the labor market. Now because they have had a sustained period of rate hike, and then from July 23 to now we are in September 2024 was a period of status quo on rates.
Right.
So therefore now and inflation has cooled, but labor market has also started to show signs of easing. Though we must say here that it is not an alarming situation, it's just that the labor market has cooled.
Just compared to before.
Compared to before,
That's
yes.
all.
So it has cooled as compared to before, which was expected because of sustained rate hike. So that was affected, but overall it's not a very alarming situation in the labor market. And also if we look at the US GDP, the latest numbers for April to June shows that US GDP posted a growth of 3%. So it's not GDP is growing fine, consumer spending is growing fine. So overall, we are in a the US economy is not showing recessionary situation, but again, what the Fed governor says is that they are concerned about the slowdown, and they don't want this slowdown to turn into a deep freeze of the labor market. So that is why this is kind of a preemptive measure that they have taken on the 50 basis points rate cut.
So then now, how do we see this impacting India?
Yeah, so typically, so one is the conventional response and one is the actual response, which would depend on what happens here, what is the RBI's policy intervention and other steps. So let's look at the typical conventional response that should happen. Now that the Fed has cut interest rate, the differential between India's interest rate and the US interest rate has widened. Because US has cut rate, India's interest rate is similar, is the same. So the interest differential has widened. So it should propel greater inflows of foreign capital into India's assets, India's equity and India's bonds. So emerging markets become more appealing when US Fed cuts rate. So that is what the typical response is, and therefore we should see more inflows and we should see markets scaling new highs.
So this would be inflows of dollars.
Inflows of dollar, foreign capital.
So that will again have an impact on the exchange rate.
That will have. So that was the second point that I was coming to. So first impact will be that it will lead to inflow, greater resurgence of capital, because till now we are seeing that the markets are mostly being supported by domestic investments. You know, markets fell also, but they did not decline by a great extent because the domestic investors supported market. They exhibited a sense of maturity, but now we should see more inflows of foreign capital in the form of FPI buying, foreign portfolio investments buying, and we are already seeing that, you know, FPIs have been buying particularly India's debt. Because firstly because of India's debt being included in the EM bond market index, and then this step will lead to increase in differential, and there is a term which is used in finance which is called carry trade, which we also discussed in the context of Japan raising interest rate. So the same concept is applicable here also, that it becomes easier for investors to borrow money in a currency where interest rate is lower and invest in a currency where returns are higher. So that is what we expect in emerging markets, not particularly only in India, but in general for emerging markets. Now whether this happens or not will also depend on valuations. In India the valuations are quite high. So this could also lead to correction in some markets. So that is one, and the other, as you pointed out, because there is inflow of capital, it would lead to rupee strengthening. Again, it will now depend on whether this rupee is allowed to strengthen or it is RBI intervenes to manage exchange rate. So if we look at the previous instances, you know, when the US Fed increased interest rate in 2022 and the US dollar index rose. So what should have happened would be that the rupee should have depreciated, but rupee did not depreciate too much because RBI intervened. And if you just, you know, compare the dollar index and rupee dollar rate, while dollar index is exhibiting fluctuations, rupee dollar has been mostly stable.
Very stable.
Very stable. Particularly from late 2022, it's kind of stable. It's just moving in a very narrow band. So if the RBI intervenes again, then the rupee appreciation will not happen and we'll see an exchange rate stability.
Okay, so now the question is, I think in October will be
Yes.
the RBI's monetary policy.
Yeah.
The question is, should the RBI follow suit? Because the thing is, compared to the last monetary policy where they kept rates unchanged,
Right.
not much has changed on the domestic front for India.
Correct.
Inflation rates are slightly lower than earlier, but still largely around the same.
Right.
And our growth is the same. So, should the RBI follow suit?
So, ideally, and what the RBI says also is that RBI's interest rate decisions and also monetary policy stance decision is governed by domestic consideration,
Right.
inflation and growth considerations. But if we do a very interesting exercise of bringing together the US Fed funds rate and the RBI's repo rate, it's very interesting that their trajectory is similar.
I see.
Yeah. So, and interestingly, if you go back to 2022, in 2022, on 4th of May 2022, the RBI had an unscheduled meeting to raise rates, and this was because interestingly on the same day the US Fed also had a meeting, and that was a scheduled meeting.
Right.
And RBI also had announced that meeting, unscheduled meeting, and RBI raised interest rate by 40 basis points, and Fed was on expected lines, raised interest rate by 50 basis points. So, while we say that, and it is true that domestic growth and inflation considerations have become more important, but the US Fed actions are generally something that the RBI or any central bank for that matter takes into consideration, and this is one very striking example of that resemblance between the Fed trajectory, the federal funds rate trajectory, and the Indian repo rate trajectory.
Right.
Now, whether RBI will do or not, you are right, nothing significant has changed on the domestic front, but what should happen at least now is that the stance should be changed.
Right.
Because now it's high time that, and if you look at the last meeting, two external members dissented on the stance that it's time to change the stance from withdrawal of accommodation to neutral, because now we are moving, inflation has edged down, and if we are giving a stance of withdrawal of accommodation, that means that we still expect inflation to remain elevated, and therefore we want to withdraw we want to make the liquidity tightened,
Which is incorrect signaling.
which
That's
is
what
incorrect
they're
signaling,
saying.
which is confusing the market participants, which is because liquidity, stance, interest rate, all these should have a consistent relationship.
Absolutely.
So, at least that should happen, and that is again regardless of whether Fed would have increased interest, reduced rate by 25 basis or 50 basis points. But what should ideally now happen is that the stance should be changed, and let's see, may not be in October, but in December or in early months of 2025. The RBI should start cutting rates if inflation continues to follow the trajectory.
So, now the thing is that if the RBI does cut rates and it does cut it by 50 basis points, then that differential will again go away between the
Yes.
US and
Yeah.
and India. So, will we again then see an outflow of dollars?
Again, RBI will intervene. RBI will intervene on the other front to prevent rupee depreciation,
Right.
which is what it did, as we see in 2022 when dollar index was rising, because at that time the increase in interest rate by the Fed was much more than the increase in interest rate by RBI.
us. Yeah.
Fed increased rates during that tightening cycle by 525 basis points.
Right.
RBI increased by 250 basis points, and their cycle was much longer. They stopped raising rates in July 23. RBI stopped raising rates in Feb 2023. So,
Right.
but during that period, particularly from late 2022, we see exchange rate stability.
So, that's the RBI intervening.
That is RBI intervening. So, though we are a flexible inflation targeting framework, we are an inflation targeting central bank, but considerations like the US monetary policy, considerations like exchange rate do feature in RBI's decision on interest rates.
Okay, and now we have several questions from the audience. Vandit asks, theoretically, it is said that a rate cut would mean money being pumped into the equity markets, which is what even you were saying we can expect. But has this practically been the case in the past?
So it has been the case in the past as well that whenever rate cuts happen, there is an inflow of capital to the Indian markets and to emerging markets. But beyond certain point, it is a short run phenomenon. Whether it is sustained or not depends on what is the policy intervention being followed by the central banks. Do they also follow suit? Like I think one emerging market central bank has also cut interest rate. Hong Kong has cut interest rate.
Right.
So they are following, because there is a pegged to US dollar, their exchange rate. So they have reduced interest rate. So there this condition would not be applicable because the differential would again remain constant. Yeah. So it depends on the policy intervention, but if you look at India's case, yes, there is a period of sustained FPI inflows, but then there are other factors also, like the capital controls framework and other things also. And in general, FPIs have been quite robust in the month of September. Because of in debt, not only in government debt but also in corporate debt, they have been net buyers. So that's a turnaround that we are seeing from July, August, but in September they have been really strong, particularly in the debt market.
Okay, and now Aditya asks a question that I feel you've answered, but the angle he's taking, I think, allows us to expand on things a little bit. He says, with the US Fed finally making a rate cut, do you think now other central banks of the world, including India, will start implementing the same? My question is specifically from the Indian perspective. With the festive season around the corner, maybe now an interest rate cut would help in increasing consumption and the purchasing activities in the economy. Now, this is an interesting angle. Does the RBI at all look at economic factors, things like boosting consumption and all of that, when it decides its interest rates?
So when it is looking at GDP, and within GDP, consumption is one of the important factors, and how RBI can influence consumption is through bank credit.
Right.
But if we look at bank credit, it has been growing strong. So and particularly the retail credit has been growing strong
while interest rates are high.
And unsecured lending has been growing strong. Consumer durables credit has been growing strong. So even without a rate cut reduction, we see that credit growth is quite robust. And the other worry for the RBI is the sluggish deposit growth.
Yes.
And if we have to talk about a monetary policy transmission, if RBI cuts interest rates, the cut will have to show up not only in the lending rates but also in the deposit rate.
Yeah.
And whether banks will cut deposit rates at a time when they are grappling for deposits, when they are accessing other markets for like certificates of deposits to shore up funds for financing credit. So all these considerations are there. Otherwise, it would have been very simple if RBI would have cut interest rates to boost consumption. But the data suggests otherwise, that bank credit is strong, and at the same time deposit growth has been languishing for quite some time now, and that is a concern which most of the banks are facing, and various policy measures have been suggested to boost demands from conventional to having deposit drives, etc.
Right.
And at that time, if the RBI cuts rates, then transmitting policy rate cuts on deposit rate cuts would be very challenging. That won't happen.
And basically also, if consumption is low right now, then it is not because people are not being able to take loans to buy things. It will be low for other reasons.
Correct.
So now we have another question. This is from Suvalagna, and my apologies if I am not pronouncing that correctly. The entire world market downturn is related to the Japanese currency, the yen. The simple solution is that the US needs to lower its interest rates to counter this, which it now has. So their question is, will the US act? But since the US has acted, I guess the extension of this is, will we see further rate cuts by the US in the near future? There are 2 more meetings, as you said.
Right. So I think the US interest rate policy would be more governed by looking at their own inflation growth and labor market consideration.
Right.
As of now, the prime concern is to give a boost to the labor market, which is showing some signs of slackening. So rather than looking at what Japan is doing, though it is a very important consideration, and we've talked about it, that the increase in Bank of Japan's interest rate resulted in reversal of currency trade, caused a lot of volatility in global financial markets, in the US market as well.
Right.
But particularly for this problem, the policy response of the US Federal Reserve will not be based on this problem. It will be more governed by their own domestic considerations, that is growth, employment, borrowing costs. So, and if we look at their summary of projections, which were released last night, they are saying that they are going to cut 50 basis points more this year, that is 25 more in November and December meeting, and the next year again they are going to cut 100 basis points, and in 2026 they are going to cut 50 basis points. So ultimately they want to reach to 2.5% because they are at above 5% federal funds rate, whereas inflation is 2.5%. So these two do not sit at they sit at odds with each other. So
Right.
they have to be reconciled. Rate cuts have to take place to be consistent with the inflation situation. So I think it's the inflation and the employment situation that would be the prime factors determining the interest rate decision.
Right. So again, just like us, the domestic factors are going to drive interest rate decisions a lot more than external factors. External factors will have some part to play, but largely it's domestic, and that's the same for them. Domestic factors and some small part the external factors. So there you go. The picture is that the US Fed has cut its interest rates by 50 basis points. This will have ripple effects on markets around the world, including India. We will likely see a large amount of dollar inflows into our markets. But now again, if the RBI follows suit and also cuts its interest rates in October by 50 basis points, then this dollar inflow might halt, it might even reverse. But we don't know whether the RBI is actually going to do that, because our domestic factors have not really changed from the last time they met and decided to keep interest rates unchanged. So we might actually see them keep interest rates unchanged this time as well, but we'll have to wait and see. Sometimes the RBI does tend to surprise the market. But on that note, that's all we have for you. Thank you so much for watching.